Mark Lackey is Executive VP at CHF Capital, and he joins us every week. And this week we're talking about natural gas.
Right,
We've talked about it in the past.
We have, Pat, and the thing we have pointed out in the past is that one of the things that we do is we tend to play foreign markets more than North American market. Now, the North American market's recovered somewhat, as you know.
Yeah.
Spiked up last week with the cold weather, and has subsequently come back down to about 456, 458, which is kind of where we think this price should trade over the next, say, 12 months to 2 years. So again, Pat, one of the reasons that we look at China is that the price in China these days trading $16 to $17 an MCF. So it's about 4 times what it trades here in North America. So your opportunity to make money is that much better if you can find the right opportunities, particularly small cap companies that have deals with CNOC, and that's what we have, in fact.
Okay, but couldn't you make the same logic for LNG companies, for instance, that could ship into China, for instance?
Absolutely. When we get LNG up and really running, Pat, right now there's a limited amount of LNG getting into China. Most of it comes from Indonesia and some from Australia. But when we start doing that in North America over the next 5 to 10 years, there's going to be some great opportunities. But in the near term, there's really not the same opportunities because obviously the pipelines haven't been built. They haven't actually, they've been approved, but they haven't been built. And of course, LNG plants will have to be built as well.
Okay, separate argument then on natural gas in China. It's sitting at $16. Russia has lots of natural gas. Now, right now, they're shipping it through Ukraine into Europe. I mean, couldn't they just turn, if Ukraine becomes a problem, couldn't they turn the tap and send it to China?
Actually, right now, China does get a fair amount of gas from Russia. That's actually a true story. So it does flow that way. The Russians have both Europe and China as clients. They'd like to keep it that way, presumably, obviously, but we'll see how things play out in the Ukraine and the rest of Europe. But I think that's actually been a situation for quite a while where the Russians are the only people that have a pipeline into China.
Okay. Are the Chinese finding any on their own?
They're trying to, Pat, and they're wanting to improve their air quality, and one of the ways to do is to find natural gas. They have been finding it onshore, they have been finding it offshore. The company we're going to talk about today is an offshore player in China, and that's where a lot more development's taking place because there's some pretty good looking fields offshore China.
Okay, so is that Primeline Energy?
That's right. That's right,
okay.
Pat. And Primeline, PEH, we like the story because in fact they have found gas. They're about to ship it in the next 3 months. There's only about 2 kilometers of pipe that has to now be finished in order to get the pipeline to the hub. And their partner is CNOC, which is one of the biggest oil and gas companies in the world. So the fact they had CNOC as a partner, that's when I like the story because it de-risked the project.
Oh, okay. When you say it has to get to the hub, the Henry?
No, this is a hub in China.
In China.
As opposed to Henry Hub, Louisiana. Their hub in China, it's not that far actually from Beijing, and there's only 2 kilometers left onshore in order to link up this particular pipeline, which is offshore, to the onshore situation. So we will see gas flowing from this field probably late June, early July.
Okay, so is there any risk that the politics change? And we're looking at politics between China and Japan, but companies can often get caught up in that whole mess. Is there a risk that
Yeah, no, it's a good question, Pat. I mean, that's why some people have said to me, you've only really looked at Primeline, you haven't looked at some of the other possibilities. I know the Primeline management, I know they're tight with CNOC, I've met the CNOC people, I know this deal's going through. So that's one of the reasons, Pat, why I've only got really one play that I'm playing over there, because I know that this is a deal there's really very little, if no risk involved here because of the players that are involved.
Oh, okay. How about Greenfields Petroleum?
Yeah, Greenfield's a little bit different. They're in Azerbaijan. Now, I had some people phoning me up this week with the issues in the Ukraine saying, are you worried about Azerbaijan?
Yeah.
I'll say right off the top, no, I'm not. For the simple reason that the government in Azerbaijan and the government in Russia are very close. They've had a long-standing relationship about shipping oil and gas from Azerbaijan into Russia, and I would suggest that that situation is not going to be affected by what's happening in the Ukraine. That's a completely different situation. Investors should recognize that that's a completely different situation.
Okay, and you like Greenfields because?
Well, they're a producer, Pat, and again, natural gas prices in Europe anywhere from $7 to $10 an MCF. You'll get a higher price there. And they've gone into Azerbaijan, which was in the old Soviet Union, one of the better places to produce oil and gas. And so it's a very pro-oil and gas regime. They found a lot of gas and oil here, and they continue to drill in old fields, which is a smart move with good technology. It's what we're doing in Alberta, after all. And you go into old fields with better technology, and you're able to find oil and gas that other people didn't. So that's their strategy. And as I said, they're getting a price that's far superior to what we would get.
And they've got actual production as opposed to Primeline, which is prospective production.
That's right. Primeline near term. Greenfields right now, they've been producing over the last couple of years.
Okay. The last name you've got is Victory Nickel. It seems counterintuitive.
Right. Well, that's interesting. That's right. And as I said, Victory Nickel didn't put their head in the sand. They started shipping sand. So they're in the frac sand business, Pat. They had both frac sand and nickel on their properties. They also had a property in Wisconsin. They recently shipped their first frac sand shipment to Alberta. In fact, they just got paid, I think, yesterday. So it's a good strategy here, Pat, because we see a growing demand for frac sand given all the fractionation that's taking place.
We should explain what frac sand is.
Okay. Frac sand is a sand that's used, Pat, in the fracking procedures in order to allow oil and gas to flow more easily out of the fracking procedures. And without frac sand, you couldn't frack these wells, or you certainly couldn't frack them very effectively.
Are they environmentally more sensitive? Do they allow for less use of chemicals, for instance?
Well, actually they do, Pat. If you go back in the days when I was fracking wells 30 years ago, we probably used some chemicals that you certainly wouldn't use today. So it's a good point that additional frac sand has made the process more environmentally friendly, no question about it, and it has allowed for, obviously, given the fracking that takes place today, some terrific results that we weren't able to get, say, 25 or 30 years ago when I was in the business.
Yeah. Well, you're still in because you're looking at it all the time.
Well, absolutely.
Primeline, Greenfields, and Victory Nickel, the three small caps we're looking at. Mark,
that's right.
Great to have you back.
And we'll see you next week. Probably do iron ore next week, Pat.
Iron ore next week. Mark Lackey, always coming with some CHF Capital Markets Executive VP there.